Knowing what your stocks are worth is one of the most critical aspects to investing, and yet most people don't know how to do it effectively. 2 weeks ago, I talked about Microsoft falling $400 billion, and even then, I still called it overvalued. And as I started posting videos on social media, I got a lot of negative reactions to that take. People were calling me crazy, insane, that my process was illegitimate, not realistic, all these different things, you name it, simply because I said the stock was still overvalued. And it got me thinking that really, I think there's a huge gap in understanding between what people perceive as value and what they think something is worth and what is actually the case. And so in this video, I thought it would be a great idea to talk about what I think the right approach is to valuing a business, and then also highlight many of the biggest names in the market today so that you can currently see, based on my strategy, what I think these stocks are worth. And you can look up top here. I've highlighted several different businesses, so you can see Microsoft, Palantir, Meta, Google, Tesla, Nvidia, Amazon, Apple, and Netflix. We're going to talk about them all. I'm going to break down exactly how I value these businesses so you can understand my approach, why I do it. And on top of that, I hope to highlight or change your mind or your perception about valuing businesses, the importance of it, so that you can just increase your probability of success in a highly uncertain world and in a highly uncertain market where there are an infinite number of variables or factors coming into play that are going to swing things. At the end of the day, you want to make predictable, confident investments where your conviction can stay strong even if a stock falls 25, 50%, where you are capable and you know that you are not going to be overwhelmed and you will buy more because you believe that the business is durably or sustainably built to endure no matter what comes its way. So first things first, here's what I saw based on the comments, and I'm going to address a couple points because I think that it's worth having greater engagement. And ultimately, I want to thank people for interacting with the content, because what I'm hoping to do here is create a dialogue between me and all of you. I want to have these interactions where you are questioning my process, where you are poking holes in my analysis and finding ways that I need to do a better job of ultimately answering the things that I am essentially preaching on this channel. And it's beneficial for me too, because then it strengthens my thesis. Maybe it exposes me to my own biases, but one way or another, I think it's a mutual interaction. So I appreciate the commentary. It was a lot of negative sentiment, but that's all right. That's part of the process, and any approach should be scrutinized, especially when you're taking stances like this. So keep them coming. I'm going to definitely keep providing information and sharing my opinion, and hopefully it's beneficial to you. So with that, first, let's talk about these comments. A lot of people said, we're talking about price to earnings ratio. And for many people, the PE is their primary valuation tool. They will look at a business and it will show that it has a 10, 20, 30, 40, 50 PE and beyond. And that gives them an essential or a base scope, at least, of what they think that the business is worth. Where I think there's a problem is, one, most people use this as their only valuation tool, but then two, they neglect the influence of human behavior. Because at the end of the day, price to earnings is a direct reflection of human nature. The price itself, the market is constantly buying and selling, and in some ways, especially in the short run, it is a popularity vote. Something like AI can fuel a lot of stocks that are undeserving of a high valuation, and yet their PE skyrockets, their stock price shoots up. For the short run, that could be 2-3 years when I talk about the short run. But one way or another, it transcends the true fundamentals of the business. And so first, you're running into a problem right there where ultimately, to some extent, one way or another, every business is manipulated by the market. It may not necessarily be a true reflection of the value. And that is a direct pull from Benjamin Graham's quote, where he said that in the short run, the stock market is a voting machine, but in the long run, it's a weighing machine. And so what does the second half of that quote mean? Well, it essentially means that, yeah, in the short run, it's a popularity vote in some aspects, but at the end of the day, the fundamentals of the business what output it is providing, what value it is creating for the world, the economy, and how people perceive it. That is going to what dictates the true value of the business. So people often get misled from that standpoint. The second element of it is, well, let's say you're using price to earnings and you're comparing businesses of similar caliber. So, I mentioned a lot of the biggest names to date. They're all major tech companies. A lot of them are developing AI. Well, let's say that Google has a 20 PE, Apple has a 25 PE, Tesla has a 36 PE. Well, when you're comparing at that basis, you're going to say that, well, Google has the lowest PE, so it must be the most undervalued. But once again, if you are looking at this thing where all the companies are inflated because a rising tide lifts all boats, well, then you're being misled to think that it's cheap when in actuality, sure, it's cheap in the short run compared to its peers. But over the long run, it still may be overvalued. And that's ultimately what happens with Microsoft right now is, that 2 weeks ago, I talked about how the stock lost $400 billion in a single day. It went from, I think, a $3.6 trillion market cap to $3.2 trillion market cap. And I said it was still 140% overvalued. I believe the true worth of the business was $1.3 trillion. And so it's still in this bubble territory. And even though maybe there's a short dip and people often buy the dip, it's not a true dip. It's just it's shedding already excess that exists. And so that's why this approach that I do is what I believe is extremely important, which brings me to my next point. And I think that's figuring out how to actually value businesses, because you don't buy businesses with PEs. You don't go, here, I'll give you 10 PEs in exchange for Google. No, you buy it with cold, hard American cash or Canadian dollars or wherever the stock trades. And so you should be thinking in dollars. And not only that, I don't think it's worthwhile to look at stock price alone, because if you look at a stock that has a price of $10 per share versus $1,000 a share, the $1,000 per share company could be a lot more attractive than the $10 per share. It's all relative to the amount of shares outstanding. So it's time to start moving away from looking at stock price and start looking at the whole picture. Look at market cap and look at the company value as a whole. So now that we want to spend using dollars and we've got cash that we want to deploy, the next step is you want to start treating it like you are a business owner and you are going out and acquiring the companies or the stocks that you would like to own. And by that, I mean that you are buying the whole business outright. Now, I don't have $1.3 trillion, but I'm still behaving in the same manner. And why do I do that? Is because let's treat it like this was a family-run business. You have been operating for 50 years and you're going out to make another purchase to ensure that your livelihood, your family's livelihood can endure for multiple generations and beyond. Well, if you treat it like that and you're going out and purchasing the entire business, then you're going to put a lot more consideration into the price you would pay. You're not going to overspend. And frankly, you do this in your regular life all the time. Whether you're buying groceries or you're buying a car or even a house, there's many different aspects of your life where you put consideration into how much you'll spend. You set a budget for yourself and you make disciplined decisions that ensure that you can still uphold your livelihood and your quality of life without jeopardizing yourself over the long run. But when it comes to stocks, for some reason, people overlook this all the time. Again, they're trying to chase trends. They a lot of the time look too far out into the future and say, oh, well, Tesla is developing Optimus robots and taxi cabs, and they are at the forefront of AI and all these things. But ultimately, you don't know what those businesses are worth. Nobody really does. The market will dictate that when the time comes. And so you're purely speculating on the future, and that can get you in a lot of trouble. But people overpay all the time. And it doesn't happen in your regular life where you do this, but in the market, for some reason, whatever it is, human behavior drives a lot of misinformed, ill decisions when it comes to investing. So how do I actually value these businesses? How do I know what to pay for the entire business if I was in that position to do so? Well, There's an approach that was taught to me through university and through reading, and it's called the discounted cash flow model. And what you're essentially doing is projecting all future cash flows of the company and then discounting it at present value. And that essentially provides you the intrinsic value, or what the business is truly worth. This is not a new concept. It has been around for quite some time. And really, ultimately, what it comes down to is the cash a business produces and the amount and at what growth rate into the future it can produce those cash flows. That essentially dictates how something should be valued, whether you should buy it or not. Is it producing a lot of cash? Well, then I'm willing to pay more. If it's only producing a little, then I will pay less. And if it's producing a negative amount, well, then I hope that it's going to produce cash flow in the near future at some point soon. Or if not, I will probably take a pass on that business overall, because it's actually being non-productive in the sense that you're not actually bringing any additional cash in. You're not actually getting a return on your investment. So with that approach, I have built my own model. I use a very standardized approach. So I use the same discount rate for all companies. And my reasoning for that is that ultimately I have a minimal acceptable rate of return. And so the S&P 500 over the long run has produced about roughly 8 to 10% returns annually on average. And I want to be above average. So I have set that to 15%. That's why I use a discount of 15%. Then in addition to that approach, what I also do is I bring in, or I capture as much historical financial data as I can. Ideally, it's 10 years and beyond. And I use that to figure out things like the 5-year return on invested capital, the 5-year profit margin, their debt to free cash flow ratio, as well as their long-term historical growth rate. And then I use that growth rate and apply that into the future on those cash flows. And you'll see that shortly here. Like, I'll provide a breakdown of all the companies and you can see exactly how that thing goes. But I think it's important that you understand why I use this approach. I think it has worked effectively for me, and it gives me, more than anything at the end of the day, why I do this is it allows me to think a lot more in relation to what a business should be worth in a specific industry. A lot of the AI companies, or a lot of, the major software hardware businesses like a Microsoft, like an Apple, they're deserving of trillion-dollar businesses because they have billions of consumers using their products or subscribe to something like Microsoft Office. But there's a value attached to that. They sell those products at a certain price. They have a cost associated with each of those products, both from actually being able to produce that output. So that would be, like the energy used, or a manufacturing plant, or the actual process of manufacturing. But they also have human capital. They have employees that they need to pay. All those products that they create, they have a cost associated to it. And then after that, if you can do it at a profitable rate where you can sell your product or service at a higher rate than the expenses it takes to generate it, well, then you're producing cash and you're producing a growing business that is sustainable. So they're deserving of those valuations. But, something else in a much more difficult market, maybe an industry like the airline industry, where their costs are much more higher, well, you're going to see lower valuations. You don't see any trillion-dollar airport or airline manufacturers out there. And that's frankly because it's a much more difficult business and harder to produce that kind of output, and you just don't capture as many dollars back. So with that, I think it's worthwhile. First and foremost, you can see here, I've updated about 38 companies, and there's still about, I think, 106 more that are supposed to provide their numbers in a short period here. And so that's something that, we got to look forward to. I wish more of them had produced their numbers, or at least on bar chart had the numbers made available, but we can work with what we got. A lot of these businesses up here, you can see, have 2025. So that's the most recent data. I literally just updated a lot of these major companies. So it gives us the true scope. And so, after this, when people are scrutinizing me and being like, well, this isn't realistic, it's purely based on the productivity of the business. So first and foremost, we're going to go back to the business from 2 weeks ago. The main headline, the one that a lot of people were driven mad by, and I'm going to break it down for you. So what you can see here is the company's financial data. I have revenue, net income, book value, debt, operating cash, the capital expenditures, which produces operating cash minus capex produces their free cash flow. And these are the 6 financial metrics that I prioritize above else. Well, really, I should say 5. So revenue, net income, book value, debt, and free cash flow. Those are the 5 that I care about most. And I look at them from 2012 to 2025. I want a picture of what the company has truly been capable of producing based on the products it creates, how much profit it can retain from that, whether it's continuing to acquire assets while limiting their liabilities, and then lastly, how much cash flow it produces. And from there, what I'm doing is producing long-term growth rates on an annual basis. So you can see 9 years. So that would be from 2016 to 2025. That's how you get that. We got the 5-year growth rate. So that would be from 2020 until 2025. And then the 3-year, which is 2022 until 2025. I weight the longer term growth rate much higher at 0.6 than the 3-year. And this produces a weighted average for revenue, net income, book value, and free cash flow. From there, I then combine these again and weight them once more, where I prioritize free cash flow at the highest, book value next, and then net income and revenue last. And so why do I do this? Well, free cash flow is the direct driver of what a business's value is derived from. And so I put the most weight on that, a significant amount of weight. If you're bringing in cash at the end of the day, more cash than the inputs that you put in, the cost that you cover, then you're on the right track. That's ultimately the goal of any business. And it gives you, if you have a lot of free cash flow, it gives you a much clearer idea of what the companies are worth than one that is either fluctuating all the time or negative. And so this gives me the best scope. Combined, that gives me a weighted long-term growth rate average. And again, this is purely based on what the company has produced. This is not a number that I'm kind of pulling out of my ass. It is right there. The numbers produce it. And now I certainly tweak it to kind of fit my strategy and what I believe is most important, but it's still a direct result of the business itself. And then for a terminal growth rate, I slash that in half. So it's now 50%. And that essentially is after a 5-year period at growing at 15%, growing the free cash flow at 15%, I then from year 6 and beyond, essentially into the future forever, this is the growth rate that I'm attributing to the business. And there's a formula that you can use called the terminal growth rate or terminal value of the business that gives you this scope. So you can actually calculate all the future cash flows of the business into the future. What's the present value of those future cash flows? So using these, I can then derive what the business is worth by discounting it at a 15% discount rate. And as I mentioned, I use the same standardized discount rate. It is a 5% premium on top of the long-term average of the S&P 500. So essentially, anytime that if I can purchase a company at what I think it's worth or below, my expectation is that I'm going to generate on an annual basis above 15%. And that is the goal. It's not always the case, but by using this conservative discount rate, you're giving yourself a much better chance of realizing that return that you want. And it gives you an added protection. Like I can change this to 10%, I could change it down to 5%, and the company's value is going to increase as a direct result of that. But again, then you're essentially saying, or you're accepting that your internal rate of return is going to be much lower. And I don't want something that's 10%. If that was the case, I should just buy an S&P 500 index. It doesn't make sense to go buy individual stock. And at 5%, well, you're just kind of deceiving yourself and allowing, again, you're now underperforming the S&P 500. So it just logically, rationally, it doesn't make sense why you would do that. But from that, we can see that the next part of this process is what I'm looking at here is, so these are the cash flows projected in the future. And what I do in the next annual year, this next upcoming year, is what I do is I pull a 3-year average of the company's free cash flow over that time. And now why do I do that? Well, I ran into a lot of situations where free cash flow does fluctuate. Amazon's a prime example, and you'll see that shortly here, is the company went from like $30 billion of free cash flow, and then dropped to negative 20 billion and then swung back up to 10 billion. And so all these fluctuations, any single year can be an outlier and things can happen. Unique events can affect good or bad the free cash flow. And so I'd rather use an average that is kind of more reflective of the recent period and what they have been capable of, but factoring in on a more longer term, a more consistent basis, what the realistic look of that business is. So that's the average here. And then it grows by that growth rate here that I've calculated. So over these next 5 years, each year it is compounding by 15%. And then down here, this is the terminal value formula. So it's essentially the free cash flow divided by your discount rate minus, so in this case, the 15% minus my terminal growth rate here of 7.5%. And that produces the terminal value there. And then from there, you're going to get the net present value by discounting it back further. So this is from year 5, this terminal value. So discounting the terminal value as well as the free cash flow that is projected in the next 5 years and bringing that back to present day. And all I mean by discount is that you're essentially dividing here by the this number here is that 15% once again. So here's the free cash flow, here's the free cash flow divided by that 15% here. And you need to factor in the period. So we're going back 5 years from this point to bring it back to present day. That gives you the net present value. So many people use this, but then the last step is to figure out the value of the equity. So we don't want to factor in debt because that's ultimately a liability. It's not something that we own and we have to pay it back. So I like to take out debt and then I like to add back their cash on hand. And in this case, Microsoft has $40 billion of debt as of 2025, long-term debt, and $102 billion of cash and marketable securities. So, but with that, the net present value minus the long-term debt plus the cash it has on hand, that produces the intrinsic value of the business. You can see it on a per share basis here, but here's how I got to $1.3 trillion. And like I said, right now the company has a $2.9 trillion or $3 trillion market cap at this time. But I only think it's worth 1.3 trillion. So it's overvalued. It's still a really good business. Like the company produced $282 billion of revenue, $102 billion of profit, and even $72 billion of free cash flow. It's a phenomenal business. But what's happening here, and you can kind of see it, is that their growth rate, especially their free cash flow growth rate, has really slowed down in recent years. So, over this time, and if I had a chart, I could show you, but let's say that during this early period that I was tracking, it was growing at this level, its free cash flow. Now it's starting to taper off. It's still growing, but it's not growing at the same clip. And the reason for that is Microsoft is a massive company. Like there are so few businesses out there that are producing above $100 billion of revenue and 50 billion, even like $30 billion of profit out there. Same thing with free cash flow. And so it's a massive business. It's realized a lot of its potential, and there's only so much more it can essentially extract from customers unless some game-changing new product or service comes out where they are the pure dominant position. And that's really what you've seen with Nvidia recently. And you'll see that here is their free cash flow, their revenue, their profit all skyrocketed in recent years because they are the premier designer of semiconductor chips. And so that's like, it's a good example, but you just need to look in perspective based on the output the business creates, what it's truly worth. So I provided my explanation for Microsoft. You can now see I've laid out my entire strategy, how I got to $1.3 trillion of intrinsic value. It's still a very good business. The company over a 5-year average has produced a 30% return on invested capital. It has a 36% profit margin. It's growing at 15%, and it only has 56% debt to free cash flow. Really good numbers. It is just overpriced, and that's not a fault of Microsoft at all. That is more a direct result of human nature, of the market being overexcited, irrationally exuberant towards the stock because it is tied to AI in all these technology markets. This is not Microsoft going out and misleading people. They are going to continue to invest and operate as they should, but the market itself is pricing in too much favorability, speculating too much on its future, and it has led to a disconnect between what it's truly worth and what the market perceives it presently worth. At the end of the day, what I do with this information is I just essentially sit on the sideline. All I'm saying is because I think it's worth so much less than it's currently trading for, I'm content not investing in it. That's all it really comes down to. I won't push anything else. That's it. I will wait. Maybe the stock will come down to a reasonable price and I would love to buy it, and I would. But for now and for the foreseeable future, I don't anticipate making it a worthwhile investment for me. It's just the price is too high and I'm not willing to pay it. And Mr. Market's going to do that for you all the time. It's going to come to you with a price every single day. And you have to make the decisions as to whether you want to make the investment or not. Now that we've covered Microsoft, I'm going to do a bunch of detail here. We're going to go a bit quicker with each of the businesses here, but I'll review their recent financial data, provide maybe a couple highlights or thoughts on it, and then we'll get down to the business of valuing the stock, and I'll tell you exactly what I think the business is worth. So moving on to Palantir. Why did I choose Palantir? Because everybody's losing their mind right now that Michael Burry has a $1 billion short position. This is a business that it has really exploded in recent years, both due to the rising conflicts, but as well as their connection and their technology, how it relates to artificial intelligence. It's really impressive stuff, but it's also something that, you have to look at. So their CEO, and not necessarily Michael Burry, but their CEO has called out short sellers in the past, saying it's ridiculous. We're the most dominant military software intelligence company out there. What are you going to do to stop us? But at the end of the day, once again, comes down to the fundamental. Is the price that the market is currently factoring in reflective of the true value, the true output, the true productivity of the stock? And well, in this case, you can see that we only have up to 2024. They should be releasing their 2025 information very shortly, or they probably did, but it's not factored into bar chart yet, so I haven't updated it anyways. But you can see that in the most recent full year, they produced $2.9 billion of revenue. They produced $500 million of profit, and they have free cash flow about $1.1 billion. So decent numbers for sure, especially for such a young company. Its long-term weighted revenue growth rate is 29%. Net income, it only started producing a net profit in the past couple of years. So on a 3-year basis, hasn't been factored in. Book value growing at 24% and free cash flow growing at 13%. This produces a long-term growth rate of 15%. And using 3-year average of free cash flow, in its first year, it'll produce 1,500. Grow this continually. By year 5, it'll produce about $2.6 billion of free cash flow, and then its terminal value is $35 billion of free cash flow. We discount that back at 15%, and this produces a intrinsic value of $29 billion. Now, when you look at that, you're going to see that Palantir's market cap is currently $286 billion. So a huge, huge disconnect between what the market believes it's worth and what I think it's worth. I would agree with Michael Burry. The stock is overvalued. It has benefited tremendously from the recent market hype. It's a fantastic business, a huge, super valuable asset for the United States military and also likely many other customers. But at the end of the day, the market is pricing in way too much for what it's currently producing. It's only producing $3 billion of revenue this past year and $1 billion of free cash flow. And yet you think it deserves a $286 billion market cap? I'm fine passing on the stock right now. I think it's, again, an interesting company. I would definitely want to continue tracking it. But at its present time, based on what it has produced over the past 6 years, I do not think it deserves that valuation. It is definitely overvalued, and I would take a pass, and it's time to move on. So moving on to the next one, we can look at Meta. And Meta is a stock that I actually presently own. We've owned it since 2022. And ultimately, at the time, the stock was trading at a really attractive price. It had fallen 70% in market value because of its spending in virtual reality. People thought that TikTok was going to overtake it. It crushed the stock. It fell to, I think it was like $250 billion at one point, and that was the prime opportunity to pay. That's exactly what I'm talking about, where there's going to be opportunities, there's going to be catalysts where the market overreacts in the other direction, sells off tremendously, and the stock gets absolutely crushed. So with that, the market currently has Meta at a $1.6 trillion valuation. I think the company's much closer to being worth $1.1 trillion. So even Meta today is overvalued. You know, the company has a long-term growth rate of 18%, a terminal growth rate of 9%, and discounting that back, we get this present value of $1.1 trillion. Still a really good number, but it is still overpriced at this time. I am right now content. I bought my stock back in 2022. I've held it for that whole time, and right now I'm fine waiting. I would love to continue owning more Meta shares and purchasing it at an attractive price, but now is not the time. Sit back and watch. And we can look at the numbers here. Like in 2025, they're producing really strong results. Again, $201 billion in revenue, $60 billion in net profit, book value of $217 billion. This is notable, they made a huge jump in the amount of debt they've taken on. So this obviously is reflective of their push to develop their AI models. They're striving for super intelligence. Will it pay off? I don't know. It's kind of, I'll share my thoughts on AI at some point anyways in these videos, but it's a huge investment that they're essentially making. You can see that in their capital expenditure as well. So last year they spent $37 billion. This jumped up to $70 billion of capital expenditure. So the good thing is it's still such a huge, highly profitable business. You know, it's a cash cow when it comes to their social media assets. And, you know, they are coming out with AI products as well. They even have the VR, even though it clearly has been a money-losing machine for most of the recent period. But for the most part, still a very, very highly productive business, producing $46 billion of free cash flow just this past year. So really good business. You can see their return on invested capital, 24%, net profit margin of 31%, their growth rate, as I said, 18%, and their debt to free cash flow of 127%. So a big jump in debt to free cash flow, but still very manageable. And frankly, it's one of the best businesses out there. Again, it's just overvalued. That's going to be a common thread here that you see is a lot of these big companies, the Magnificent Seven stocks, they're just overvalued at this time. And this is not anything new. A lot of the time, the biggest names in the market are going to trade at a premium. It's very rare that you're going to find them at a super attractive price. But as I'm aware, this is essentially implying that the market cap is $500 billion above what I think the company should be trading at and what its long-term likely course or trajectory is headed to. So I would argue it's probably going to contract a bit. And especially if the economy slows down, especially if the hype around AI starts to dial back and really reel in, well, you're probably going to see a correction, something similar to what Microsoft happened or experienced. And it's just, that's part of the process. You have to be aware of what something's worth and be comfortable moving on. Now, for another company that I've owned, and I purchased Alphabet back in 2022 at the end of the year, whereas I purchased Meta at the beginning of the year. Another phenomenal company, again, one of the best businesses in the world. I use Google probably every day as a consumer in many aspects. I'm using Google Sheets right now. So it's very valuable in a sense, but it's ultimately, once again, reflective. The value of a business is reflective of its fundamentals, of the output, of the value it creates for the world. And then you want to purchase it at an attractive price. So with that, Google currently has a $4 trillion market cap. I think the company is worth $1.3 trillion as well, just like Microsoft. It has a long-term growth rate of 14%. It has a return on invested capital of 27%, a profit margin of 27%, and a debt to free cash flow of 64%, all phenomenal. But based on that growth rate, based on the free cash flow it is presently producing and how discounting it back at that 15%, I think it's worth $1.3 trillion. The stock right now has a $4 trillion market cap. It just doesn't make sense to buy. At the time when I purchased this, I'm pretty sure it was close to that valuation. It was like $1.3 trillion. You know, once again, it was kind of getting scrutinized as well. The market was slowing, especially after the 2021 bubble popped, and it was a really attractive time to buy. And You're going to find times like that. You just got to wait. You got to be patient. You got to think in 10-year periods, not just 1 or 2, even 3 years, because a lot can happen in that time. A lot of irrational behavior can occur, and you just want to stay disciplined. At the end of the day, the value allows me to stay disciplined. It says, this is what I think it's worth. This is what it's trading at. Will I say no at this time and wait? Most often, it is yes. I say no to 99% of the opportunities that I come across, whether that's because of the fundamental, the quality of the business, or because of value. And again, I would love to own more Google shares, but I'm just going to wait on the sideline until I find a more attractive price. And it seems like based on its current market cap relative to the value of the present business, and again, this is on the most recent financial data. This just came out a month ago, that the business is worth a lot less than what it's currently trading for. Next one. Everybody loves Tesla. A lot of Tesla fans out there. A lot of people, big fans of Elon Musk. I think he is one of the best innovators. I mean, he's the richest guy in the world for a reason. He's built so many businesses. Hyper crazy entrepreneur with so much to do, but his business is kind of struggling. And so first I want to highlight that in 2025, revenue dropped from last year and even 2023 down to $95 billion. The profit has really taken a hit since 2023. They had $15 billion of profit back then. Now they're only at $4 billion. So that's a huge decline in the amount of profit of the business. Free cash flow actually doing okay. I think it's their second highest all time. It looks like here 2022 is their highest, but it's still on a longer term basis, at least on a 3-year basis, it's down overall. So it's not necessarily one way or another. They are facing some challenges in trying to continue to sustain growth at an effective rate. And what you're going to see here is that I think Tesla is overvalued. The company has a market cap of $1.6 trillion. I think the business is worth $360 billion. So massive disconnect in the price. A lot of people have talked about it, but it has a long-term growth rate of 13%, a return on invested capital of 16%, profit margin of 10%, and a debt to free cash flow of 108%. So decent business for sure. But based on its current growth rate and discounting it back at present value, it is worth way less than what the market currently has it at. And this is a company that I definitely anticipate will probably see a correction at some point. You never know when they're going to happen, but there's just such a separation there. I think it's going to be a very long time before I ever get a chance to buy Tesla at an attractive price. So be it. There's other opportunities in the market. I will just look elsewhere. Now is not the time for Tesla. Now for another darling child is Nvidia. Again, the most impressive company, let's say, in the past couple of years, and they have truly benefited. That's what you're going to see here. 2023, they made $27 billion in revenue. This has skyrocketed to $130 billion in revenue in just 2 years. That is ridiculous. Same thing with profit. $4 billion in net profit, up to $73 billion today. Ridiculous. Free cash flow. $4 billion in free cash flow, up to $61 billion in free cash flow. Their growth rates are insane. You can see that on a 3-year, a 5-year, and a 9-year basis. Their growth rate actually is at 59%, which is absurd. And so here's a good point is anytime that a company exceeds a growth rate of 25%, I get a little woozy, let's say, where I want to ensure that it's not kind of getting out of hand. And high compounded annual growth rate like this will really inflate the value of a business overall. So I essentially cap it at 25%. Anytime a company exceeds that, I still make note of it and keep track on my comparison sheet that it is 59%, but its value is maxed out at a 25% growth rate. And why do I do that? Well, do I think that Nvidia, now that it has $130 billion in revenue, is going to be able to continue to grow at 60%? Same thing with its net profit. I think it's very, very rare, very difficult. I think the most revenue right now is between Apple and Google. I think that, actually Walmart is up there too, kind of an outlier compared to the companies we're talking about now. But realistically, to grow at 60% for another 5 years, I don't see it happening. So that's kind of what I'm dialing back my expectations. That allows me to keep myself more grounded. So with that, I talked about it. Nvidia currently has a $4.4 trillion market cap. The company's value, or I believe it's worth $2 trillion. So Nvidia is also massively overvalued. And even though it has a 59% growth rate, a return on invested capital of 40%, a profit margin of 37%, and only a 14% debt to free cash flow, it is a bit too pricey. It is the most highly valued business in the market to date, so it is the ceiling. To say that it deserves a valuation beyond that, it's definitely possible, but it's just not realistic at this time. And so it is a company that I would love to own. I think they truly are dominant. Their products are the best in the world, and you can clearly see that, but it is just too pricey, and it has benefited too much from the AI market hype. And so for now is a time to just sit back and watch and allow it to kind of play out. And once again, if it hit that $2 trillion market cap, I would probably be buying in an instant. It is one of the best businesses out there. But for now, the price is too high. I'm content sitting on the sideline. Moving on to another major company, both between AI but also e-commerce, is Amazon. Everybody knows it. Fantastic business overall. But I think it is worthwhile highlighting, and I talked about it earlier in the video, is they did have a stretch there where they produced negative free cash flow. So there was kind of a point in time where the shipping costs and the manufacturing costs exceeded what they were able to generate in profit and cash. And you saw that they took a massive hit. Like profit in 2021 was $33 billion. That dropped to negative $3 billion the next year. And now it bounced back, and they've certainly been on an uptrend, but free cash flow actually has struggled a bit more. And, even in 2025, you can see the recent data that they have produced a lot of less free cash flow. And why is that? Partially it's because, well, they're spending $128 billion in capital expenditure, a huge jump from $83 billion the previous year. Once again, they're in the AI race. They are investing in data centers and building out their models. And so this is another reflection of that. A lot of these major companies, you're seeing huge investments, a massive increase in their debt. Same thing here. Amazon was spending $53 billion in long-term debt in 2024. This has jumped to $66 billion of the recent year. So they added another $14 billion of debt. This is to help fuel growth. They're taking in extra cash. They're making a huge push right now. We'll see if it plays out as they expect, but phenomenal company. That said, with a 16% long-term growth rate, return on invested capital of 12%, a profit margin of only 6%, I think that Amazon is also overvalued. The company has a $2.1 trillion market cap. I think the business is worth much closer to $1.4 trillion. So that's about $700 billion that I think it's trading at a premium right now. Another fantastic business, one that I would really like to own at some point, but based on what it has currently produced in the most recent years, as well as its longer term growth rate, it is overvalued. I am content sitting on the sideline. Next up, another one of the most popular companies out there. Obviously, Apple is the producer of the iPhone, the MacBook Pro. It is the premier consumer technology product developer in the world. And it's a great business, but it is also a very old and mature business. And so whereas a lot of these companies, you have seen double-digit growth rates for the most part, Apple only actually has a long-term growth rate of 4.3%. And at a market cap of $3.8 trillion, I think it is significantly overvalued. I think it's much closer to being worth $900 billion. So it doesn't even deserve the $1 trillion valuation, and yet the market has overpriced it. Now, there was a time when Apple was growing phenomenally, and if you go back to, say, 2008, when after following the launch of the iPhone, like these numbers have just skyrocketed. And even if you look here, you can see strong growth. Like the company's producing $99 billion of free cash flow, $416 billion of revenue, and $113 billion of net profit. But its growth has really slowed down. It's a very mature business. It's been around for 50 years now at this point, and the products are maturing where they're not necessarily introducing anything novel that is game-changing. And, they made a push, an attempt with the Apple Vision Pro, but it hasn't been adopted. VR has not been adopted like even I necessarily anticipated, but the technology is just not there yet. There's going to come a time when it's going to be hyper realistic, and I think it will be much more integrated, but now is not that time. It is being reflected in their growth. This has not become their premier product as maybe they were hoping for. And so the growth rate is really, really slow, even disappointing, you could argue. But more than anything, it's just you can see that there's a huge disconnect between what the market cap, the stock price is currently trading at, and what I think the business is worth. And so this is another company that, at a reasonable price, it's one of the best businesses in the world. I would love to buy it, own it, but now is not that time. I'm content sitting on the sideline, and it looks like it's going to be quite some time until that is realized. So with that, our last company here, and this is another interesting one. Netflix is obviously a fascinating business in many regards because it kind of burst on the scene. But you can see here that the company has a long-term growth rate of about almost 25%. And you can see that in their free cash flow here. Like really, they're either negative or producing very little in the early part of the 2010s. And this is grown at an impressive rate. And more than anything, 2025 was their best year. They had $9.4 billion of free cash flow produced. They had $45 billion of revenue record and $11 billion of net profit. So all records there. You're seeing good growth across the board, and that is being reflected in their long-term growth rate here. Their return on invested capital is at 19%, profit margins at 19%, and like I said, their growth rate's about 25% at this time. So that's favorable. That's good conditions, and you are seeing that being reflected. So the market cap right now is trading at $26 billion, and I think the business is worth about $494 billion. So trading at a reasonable price relative to what I think the company is worth, and it's undervalued at this time. So what are the next steps? Well, if I want to invest in a company like Netflix, the next step would be to really dive into the operations of the business. I want to start to understand what differentiates their streaming platform to others. How are they going to sustain it? Can they sustain it? Is this 2025 output a one-off? Are they going to contract from that point on? Or are they going to be able to maintain it because they do things differently than their peers? And so the starting point, and this is kind of how my approach works, is I look at a bunch of different companies, I compare the quality of them, then I want to look at their price. And if they're attractive, then the next step is to do the real deep dive where I am really exploring the business overall. I am studying as many aspects as I can to gain a full comprehensive understanding. And from that point, then I will make a decision as to whether I want to invest or not. But, close it off with one where it is undervalued and worth exploring. And that's exactly what I did with Netflix here. It's another good company to test out. And frankly, based on these results, like more than anything, the next step is to just do more research and make a decision at that point. So if you want to go check it out, definitely recommend it. At least you've seen how I approach it. And if you agree with it or disagree with it, come at me and let me know. But with that, we'll close it off as we usually do with all these updated numbers, 38 new companies updated, as well as the finances updated. I will give you the top 10 stocks of the second half of February. And so with that, the top 10 stocks as of the second half of February are at number 1, Doximity, at number 2, Bank 7 Corp, at number 3, Texas Pacific Land Trust, at number 4, Deckers Outdoor Corporation, at number 5, Euroseas, at number 6, Paycom Software, at number 7, Copart, at number 8, Kinsale Capital Group, at number 9, Catalyst Pharmaceuticals, and at number 10, Qualys. So if you got this far, thanks a ton for listening. Again, I highly encourage you to question my approach, provide your own opinions, and create this dialogue, poke holes in my thesis so that we ultimately get better together. But overall, thanks a ton for watching, and I can't wait to do the next one.